All right, in this lesson, we're going to continue our conversation when it comes to consolidations. We're going to look at one aspect of consolidations, and then we'll get to, in other lessons, consolidations after or subsequent to the year of acquisition. So the first thing that we're going to talk about is this idea of allocating purchase price to the undervalued assets or overvalued assets, and what do we do with those excess and not excess numbers. And so let's kind of go back a couple of steps, and if we go back a couple of steps, what we talked about was, let's say we were acquiring company B. So we acquired company B at the fair value of $100,000, but their book value is $50,000, which means if we just look at this aspect alone, we've overpaid for the company by $50,000. Now, we said in previous lessons that when we buy a company, maybe we're buying it for more than they're worth on their books because they've got assets that have appreciated in value. What do we mean? Let's say they bought a piece of land 10 years ago for $10,000, and today that same piece of land is worth $100,000. So obviously, we would pay more for the company as a whole because we're getting $90,000 extra of value in that land that's not recorded on the books. Otherwise, what could happen is the company could just sell the land, receive $100,000, and then sell the rest of the company to you, and you still don't get the value. So the reason why we pay more for a company may be because of its undervalued assets. So in this case right here, I've got $100,000. The book value of the company that we're acquiring is $50,000. So I have $50,000 of what we call excess fair value over book value. Okay, so we're paying $50,000 more than what the book value of all of its net assets are actually worth. So we said that what we do is we take that excess over book value and we try to allocate it first to undervalued, or in this case we're going to talk today about overvalued assets. So for instance, let's say they have a trademark on their books at $0. So we've looked at fair value. The fair value of the trademark is really $10,000, so we're going to allocate $10,000 of this $50,000 to trademarks. Now let's also say that equipment is overvalued on the books. So on the books that they are at $100,000, but if we take the fair value of all of their equipment, they should only be worth $80,000. So they've overvalued their equipment. So they didn't depreciate enough when they acquired, and subsequent to acquisition, they haven't depreciated enough. So it's on their books for $100,000. It should be $80,000. So we have an allocation. We're going to basically get back $20,000 to excess fair value over book value. Plant, pretty straightforward. On the books, their plant, let's say, is $100,000, but it's worth $130,000. So we're going to allocate $30,000 out of that $50,000 to plant, and then land is $5,000. Now, to make it very simple, you add them all up, and that gets your allocation to specific accounts. So notice we do have this $20,000 of overvalued equipment. It's almost like we're going to reduce, or we will be able to reduce, the equipment depreciation expense by $20,000 over the life of the rest of the life of the equipment. Okay, so we get to $25,000 by taking 10 plus 30 plus 5, that gets us 45, minus 20 is 25, which means we're going to assign goodwill $25,000. Okay, so that's what we're going to assign. Now, where we left off in other lessons is, what do we do with this? What do we do with this? And the reason why we're opening up with this kind of lesson is because we're going to talk soon about consolidation subsequent to the acquisition year. So next year, we need to consolidate, and we've got to do something with these numbers because we know that equipment and plant are typically depreciated. Well, if we give more value to them, we're also going to need to depreciate it. So this is kind of that lead into the discussion on consolidation subsequent to the acquisition year. So what do we do? So what I did here was I put it right over here on this annual excess amortization table. And we know that trademarks have an indefinite life as long as they're renewed every 10 years. So we will have $10,000 of trademarks, indefinite, intangible assets that are indefinite in nature are checked for impairment annually. So we're not going to do any depreciation or amortization there. Equipment's 10 years. Let's say that we looked at all of their assets, all of their equipment, and we said, okay, as a whole, the equipments have 10 more years of life. So what we're going to do is we're going to take that $20,000 and we're going to amortize that over 10 years because there's 10 years left. So what we're going to do is we're going to do 20,000 divided by 10 gives us $2,000. Now, that is not an expense necessarily because we're not adding value to it. We're almost reducing our expenses for every period. So that $2,000 that we have here, when we consolidate our books, we're going to actually reduce depreciation expense by $2,000. So it's almost like we're getting a credit, and I don't mean right, but credit to our depreciation expense, or we're reducing depreciation expense by $2,000 a year for the next 10 years. So that's what we would do with that $2,000. So when we do our consolidated entries at the end of the year, every single year, we're going to give back $2,000 to the depreciation expense, and it lowers it for the next 10 years. So that's what we do with that over here. Now, what about our plant? Our plant has 30 more years of life. That's what we required. So we acquired it. We know that it has 30 more years of depreciation. So what we're going to do is we're going to take the $30,000 that we've allocated to plant, or additional allocation that we've done to the plant, and we're going to reduce it. We're going to amortize it, or we call it amortizing it here, but really it's depreciation. We're amortizing it over 30 years. So 30,000 divided by 30 gives us $1,000. Okay? So on our books, what we're going to do is when we consolidate, an additional entry that we need to make is an entry for $1,000 additional depreciation expense. So here we would reduce our depreciation expense by $2,000, but then increase it by $1,000. So our net for at least 10 years, because we've got this for 10 years, our net will be, we're going to reduce depreciation by $1,000 each year for the next 10 years. Okay? And then after that, we would increase our depreciation expense by $1,000 for the next 20 years. So the 20 years after the 10 years. All right, land. Land, we're going to increase land by $5,000, except land is never depreciable for any purposes. So we are going to have an indefinite life. We'll check it for impairment, but land is not depreciable. Goodwill has an indefinite life, same thing. We're going to review it for impairment annually. So when we do our consolidation, so remember this as we talk about other lessons in the future. When we do consolidations, we're going to consolidate like we did in the last lesson. We're going to take all of their assets, include them of both companies. We're going to take all of their liabilities, add them up, then we have a consolidated liabilities, and then we remove the investment in equity account or investment in company B account by stepping up the asset accounts. So the equipment was $100,000. It should be 80, so that when we consolidate it, we're only consolidating 80 over, not $100,000, even though that company B has it on their books for $100,000. On our plant, let's assume that their plant is on company B's books for $100,000. When we consolidate, we're going to add that $100,000 to our plant numbers as company A, but we're also going to add additional $30,000 for that acquisition. So remember, we're getting rid of the investment in company B account by stepping up or stepping down our basis in the fair value of the assets that we acquired in the acquisition year. And then once we've done that, we're also going to need to book $2,000 of a reduction in depreciation expense, and then increase depreciation expense by $1,000. Now you might go, why do we do this? Why does it matter? We do it because let's assume that we were actually going to buy this equipment for $80,000, so we weren't acquiring it necessarily from company B, but we buy it for $80,000. If we did that, we would depreciate it over 10 years. Okay, so that's $8,000 a year. Okay, but what is company B doing? Well, company B has it at $100,000 on their book, and let's say they're depreciating over 10 years. They are depreciating $10,000 a year. Well, when we bought company B, we bought their equipment at fair value. Therefore, when we consolidate it, we're going to consolidate $10,000 of depreciation expense. But if we went in the open market, we would have only depreciated $8,000. So that reduction of $2,000 here brings that $10,000 back down to $8,000, which is the fair value that we would have paid. So that's this lesson. This lesson is all about understanding what we do with the excess over amortization and depreciation value.